2 years ago, Caleres traded above $30 a share, nearing $40. Today, it sits at roughly $10, trading below its book value. Every cash flow-based valuation metric has compressed. The market is valuing this company at 3.5 times trailing earnings and 2.9 times enterprise value to EBITDA. Enterprise value, or EV, measures a company's total value, including debt and cash, while EBITDA stands for earnings before interest, taxes, depreciation, and amortization, a metric used to measure core operational profitability. The entire market capitalization has fallen under $400 million. That $400 million market cap is currently less than the amount Caleres has drawn on its own revolving credit facility. A revolving credit facility is a flexible corporate loan that allows a company to draw, repay, and redraw funds as needed. Multiples at these levels carry a specific mathematical implication. The market has priced in a state of permanent terminal decline for this 102-year-old footwear company. This creates a binary tension. The company is either dying, or the underlying math of the stock is broken. This chart breaks down the Caleres dual-platform model. Revenue splits into two distinct pipelines, Famous Footwear on one side and the owned brand portfolio on the other. Both streams converge into total operating income. Famous Footwear generates roughly 55% of total revenue through its 846 retail stores. It acts as the volume-driven cash engine, running at a modest 5.3% operating margin and remaining exposed to the financial health of middle-income families. The brand portfolio segment represents the remaining 45% of revenue, but operates at nearly double the profitability, boasting 9.5 to 10.5% operating margins. It generates more than half of the total operating income. By designing owned brands and selling them directly through owned Famous Footwear stores, Caleres captures both the wholesale brand margin and the retail margin. These high margins are driven by a specific stable of lifestyle and luxury brands. This includes names like Naturalizer, Allen Edmonds, and Sam Edelman. In mid-2025, the company acquired Stuart Weitzman from Tapestry for $108.7 million to further bolster the luxury side of the house. While vertical integration creates real operational efficiencies, footwear retail lacks switching costs or network effects. Outperformance here is strictly a function of execution, not market structure. This waterfall chart illustrates the severe profitability collapse Caleres experienced in fiscal year 2025. The operating margin starts at 5.8%, steps down sharply through 3 distinct negative blocks, and bottoms out at 1.6%. The first hit came from escalating tariffs on Chinese imports. Because Caleres sourced 50% of its products from China, this inflicted a direct $10 million revenue penalty and compressed gross margins by 210 basis points. The next block represents the toll of absorbing the Stuart Weitzman brand. The integration cost $71 million and generated a $23.3 million operating loss. The final downward step tracks Famous Footwear's organic 2.3% comparable sales decline, as inflation severely squeezed the chain's core demographic. Competitors operating in the exact same economic environment, like Shoe Carnival and designer brands, expanded their gross margins during this period. Caleres failed to pivot toward higher income demographics fast enough to protect its retail side. The market reacted to this convergence of one-time costs and cyclical shocks by anchoring entirely to the resulting 21-cent GAAP net loss. Investors treated a terrible year as permanent decay. This split-screen comparison reveals the disconnect in the market's thesis. While the income statement shows reported losses, the cash flow statement shows rising free cash flow. Through the first 9 months of the fiscal year, the picture looked alarming. Operating cash flow had fallen 47% year over year, and inventory had bloated to $678 million. But in the fourth quarter, management executed an aggressive working capital pivot. They deliberately destocked and liquidated inventory, driving the balance down to $610.5 million. By clearing that inventory, Caleres pumped $63 million of operating cash flow into the business in a single quarter. This brought the full-year total to $103 million. Management took that cash and deployed nearly $60 million to immediately pay down their revolving credit facility. While the mid-year data suggested a business hemorrhaging cash, the full-year reality proved the company was successfully executing a deleveraging cycle. The fiscal 2026 recovery relies on specific, quantifiable operational levers rather than macroeconomic hope. The primary cost-saving lever addresses the tariff exposure directly. Caleres initiated a supply chain migration, aggressively exiting Chinese manufacturing. By dropping China sourcing from 50% down to under 15%, management projects a mechanical recovery of 140 to 180 basis points in gross margin. The secondary lever targets the retail footprint. The FLAR store modernization program replaces low-margin legacy products with premium offerings. Early data shows these converted stores generate a 10-point margin outperformance over legacy locations. The final lever is the Stewart-Weitzman integration. With warehouses consolidated and the headquarters relocated, the objective shifts from costly restructuring to achieving operational break-even. These three mechanical initiatives frame the turnaround as a matter of standard execution risk. Execution carries risk, and the Caleres balance sheet is not constructed to withstand a prolonged profitability trough. This visual maps out the capital structure. Caleres carries an elevated net debt to EBITDA ratio of 5.0, anchored by $321 million in net debt. Compounding that pressure is an additional $600 million in operating lease obligations for the 846-store Famous Footwear fleet. The immediate safety net comes down to liquidity. The company maintains a $237.5 million availability cushion on its revolver, and it faces zero debt maturities until June 2030. If the turnaround levers fail and operating margins compress further to 2.0%, this debt stock will mathematically consume all equity value. Buying the stock at $10 is a highly leveraged wager on operational improvement. The market's 2.9 times EBITDA multiple implies a specific future for the business. To understand the asymmetry here, we have to look at the exact assumptions currently priced into the stock. This sensitivity table graphs implied operating margins against total equity value. Right now, the market's pricing model assumes Caleres will be permanently trapped at a 3.2% perpetual operating margin. Compare that 3.2% assumption against management's actual 3-year average baseline, which sits at 6.6%. If we plot a conservative mean reversion target of just 4.5%, the model demonstrates an explosive upward repricing in equity value. This specific gap between the 3.2% terminal state the market expects and an achievable 4.5% recovery defines the asymmetry of this setup. Caleres represents a tactical value play driven by extreme mathematical tension. Investors have the financial runway to wait for the turnaround. The company's 102-year unbroken dividend streak costs only $9.7 million annually, a figure covered 11 times over by normalized free cash flow. Market participants are heavily diverging. Passive indexers are exiting due to the headline gap loss, while active institutional value funds are quietly accumulating shares. At $10, investors are purchasing a heavily leveraged call option on operational mean reversion. A call option is a financial contract that gives the buyer the right to buy an asset at a specified price. In this case, the ultimate bear case of permanent decline is already fully reflected in the price.